Stop scrolling. I need you to picture this with me. It's December 28th.
28th. You walk into a luxury car dealership. The showroom lights are gleaming off an $80,000, fully loaded SUV. You don't actually need a new vehicle. Your current car runs perfectly fine. But your accountant just called you an hour ago and warned you that your business had a monster year. A highly profitable year. And if you don't find some legitimate expenses quickly, you're going to get crushed with a massive tax bill come April. So what do? You sign the papers, you take the keys, you drive off the lot, convinced you just outsmarted the IRS. After all, it's a business write-off, right? Wrong. Dead wrong. What you've actually done is fall into one of the most destructive financial illusions in the entire business world. And today, we are going to expose it. I'm calling it the company car tax trap. We're going to break down the brutal math of why chasing tax deductions is silently draining your wealth. And then, more importantly, I'm going to show you the exact strategy the ultra-wealthy use to legally lower their taxes while actually increasing their net worth at the same time.
I am the Wealth Guardian, and the mission of this channel is to
protect your wealth through education. We bridge the gap between complex legal jargon and practical real-world asset protection. If you are serious about keeping what you've worked so hard to build, do me a favor right now. Hit that like button, subscribe to the channel, and ring the bell notification so you never miss a video. I also highly encourage you to watch this one all the way to the very end. The final strategy I'm going to share with you, a specific triple duty method involving retirement accounts, is a wealth-building secret that offers ironclad lawsuit protection right alongside your tax savings. You do not want to miss it. Before we go any further, a quick but important reminder. Everything in this video is strictly for educational purposes and does not constitute personalized legal or financial advice. Your situation is unique. Always consult a qualified professional, a CPA, a financial advisor, an attorney for your specific circumstances. All right, let's get into it. Here's the reality. As your income and your business grow, the pressure of taxes grows right alongside it. That is just the nature of the game. And it is entirely natural, completely understandable, to look for ways to reduce what you owe the government. Nobody wants to write a bigger check to the IRS than they absolutely have to. But here's where a massive problem occurs. Intelligent, hardworking entrepreneurs, smart people, begin letting the tax tail wag the dog. What does that mean exactly? It means your primary motivation for making a financial decision becomes maximizing deductions for the current tax year, rather than asking yourself the much more important question: what is the most effective and beneficial long-term strategy for my wealth? You stop thinking strategically. You start thinking reactively. And that reactive thinking almost always leads to poor financial decisions dressed up as smart tax moves. This is especially dangerous in the fourth quarter. November, December, that's when business owners get the call from their accountant. Hey, you had a great year. You need to spend some money before December 31st. And then the scramble begins. The panic sets in. And suddenly you're making 5-figure and 6-figure financial decisions in a matter of days. Not because they make strategic sense, but because you're terrified of the tax bill. That fear, that urgency, that is the breeding ground for terrible financial choices. And here's why it works so well on us. It starts with a psychological trap. We human beings have a unique talent for rationalizing and justifying the things we want. When you've had a highly profitable year, a little voice sits on your shoulder and whispers, hey, you can buy a nicer computer, a luxury standing desk, the latest gadget, that new SUV you've been eyeing, because you're going to get a tax deduction for it. And it feels like a discount. It feels like a sale. It feels like the government is subsidizing your purchase. You convince yourself that because you're writing it off, it's not really costing you that much money. Uncle Sam is paying for part of it, you tell yourself. But that is a financial illusion. And it is one of the most expensive illusions you will ever buy into. Because when you pull back the curtain and look at the actual numbers, the brutal, honest math, the picture is very, very different from what your brain is telling you. So let's do exactly that. Let's pull back the curtain. Let's walk through the real math of buying a depreciating asset, like a company car, just to save on taxes. I'm going to keep the numbers simple so the concept is crystal clear. Let's say you have $10,000 of extra cash flow in your business. And let's say you're in a combined 40% tax bracket, federal and state. That's not unusual for a successful business owner in a state like California or New York. Option 1, you take that $10,000 and you buy a vehicle. You get a tax deduction. That deduction saves you $4,000 in taxes. You feel like a genius. You're driving a new car and you just saved $4,000. But what did you actually do? Let's slow down and think about this. You just traded $10,000 of your hard-earned liquid cash for a depreciating asset. The literal second you drive that car off the lot, it begins losing value every single day. That vehicle is worth less than the day before. Now let's fast forward 9 or 10 years. That car, it's going to be worth a tiny fraction of what you paid for it. Maybe 10 or 15% of the original price if you're lucky. Even if you took the $4,000 you saved in taxes and invested it wisely, say, in an S&P 500 index fund, the combined value of your rusting, depreciated car, plus your invested tax savings would barely have grown at all. We're talking about an abysmal return on your capital. Here's what actually happened in plain English. You took an immediate and massive loss on your cash flow the exact second you decided to spend those funds on a piece of machinery you didn't truly need. You voluntarily destroyed your own capital, and you did it with a smile on your face because you thought you were beating the system. Remember this golden rule of wealth preservation, and please write this down. Capital is capital, and it should always be deployed for its highest and best use. When you buy unnecessary equipment or vehicles, you're converting liquid wealth into illiquid, depreciating junk. You cannot spend a car in retirement. You cannot easily liquidate a used laptop to fund your lifestyle. You can't pay your kids' college tuition with a 3-year-old office chair. Once that cash is converted into a depreciating asset, it is effectively gone. You have burned it, slowly, quietly, but definitively. Let me pause right here and ask you a direct question. And I want you to be honest with yourself. Have you ever bought a piece of equipment, a software subscription, or a vehicle at the end of the year solely because you panicked about your tax bill and wanted a write-off? I know a lot of you have because I've been there myself. Drop a comment below right now and tell me your story. Let's get a real conversation started in the comments section so we can all learn from one another's experiences. I read every single comment, and I want you to know, recognizing this psychological trap is the absolute first step to changing your financial trajectory. So if buying company cars and upgrading your office furniture at the end of December keeps you poor, then how do you legally lower your tax bill without destroying your cash flow? Great question. It's time for your Wealth Guardian action plan. Here is the secret of the wealthy, and it is hiding in plain sight. Wealthy people do not buy depreciating assets to get tax deductions. They buy appreciating assets. They put their money into things that go up in value over time, not down. And the absolute biggest bang for your tax deduction buck, the single most powerful tool available to most business owners, comes from investing in a qualified retirement plan. Depending on your business structure and your income level, you have some incredible options here. A SEP IRA, a solo 401k, or for higher earners, even a defined benefit pension plan, which can allow contributions well into 6 figures per year. Now let's run that exact same math again. But this time, we're going to do what the wealthy do. You take that same $10,000 of extra cash flow, and instead of buying a car, you contribute it to a qualified retirement plan. Guess what? Just like buying the car, the IRS gives you the exact same $10,000 tax deduction. You still save $4,000 in taxes. The tax benefit is identical, but here is the monumental difference. And this is where everything changes. Instead of sinking your money into a vehicle that rusts and loses value every single day, you've put your money into an investment account that historically goes up over time. You're invested in the market. You're compounding. You're building. Over a 10-year period, that $10,000 retirement contribution, compounding year after year, tax-deferred, will massively outperform the depreciating car. It's not even close. We're talking about potentially doubling your money or more, depending on market conditions, versus watching your car become virtually worthless. Instead of taking a loss on your cash flow, you receive a massive bonus the moment you invest those funds into your future. Same deduction, same tax savings. Completely opposite outcome for your net worth. Now, this requires a massive shift in mindset. And I want to be upfront with you. This is the hardest part, because the car is sexy. The car is tangible. You can see it, touch it, smell that new car leather. A retirement account statement, not quite as exciting at a dinner party. But you must stop viewing tax savings as bonus money to be spent today, and start viewing your tax strategy as a long-term wealth accumulation engine. Your tax plan and your wealth plan should be the same plan. They should be working together, not against each other. And here's another angle that business owners rarely think about. If you're aggressively pushing deductions to lower your paper profits year after year, buying unnecessary cars, expensing excessive travel, loading up on equipment you don't need, you are severely hurting yourself if you ever want to sell your business. When a buyer looks at your company, they value it based on free cash flow. That's the number that matters. And if you've artificially suppressed your profits for years, you cannot turn to that buyer and say, well, my business is actually much more profitable than it looks on paper. I was just being aggressive with deductions to avoid taxes. The buyer will not care. their lender will not care. And the valuation of your life's work will plummet. You will leave hundreds of thousands, potentially millions of dollars on the table at the exact moment it matters most. All right, I promised you a bonus strategy. This is the part you absolutely cannot miss. The reason I told you to watch until the very end, when you use a qualified retirement plan to generate your tax deductions, it performs what I call triple duty. 3 jobs for the price of 1. Duty number 1, it gives you the massive legal tax deductions you need today to keep the IRS at bay. You're lowering your taxable income. You're keeping more of what you earn. Check. Duty number 2, it forces you into an automatic savings and investment system, compounding your wealth tax, deferred for decades into the future. You're building a retirement nest egg on autopilot. Check. But duty number 3, and this is the absolute most critical part for entrepreneurs, it provides asset protection. In most cases, the funds you save inside a ERISA-qualified retirement plan are completely shielded, legally shielded, and inaccessible to claims or judgments from lawsuits and creditors. Let me say that again because it is that important. Your retirement funds inside a properly structured qualified plan are protected by federal law. Think about what this means. If your business is sued, or if you face a catastrophic personal liability claim, the money you used to buy a company car, that's fully exposed. A plaintiff can force you to liquidate those assets to pay a judgment. But the money sitting inside your qualified retirement plan, it's locked inside a legal vault. It is in most circumstances untouchable. So let me connect the dots for you. You get to save large amounts of money, receive a huge tax deduction, and have all of those funds protected from the predators of our litigious society. That is the power of triple duty. That is how the ultra-wealthy think about tax planning. Here's the bottom line. The financial industry and car dealerships want you to believe that the ultimate perk of being a business owner is driving a leased luxury vehicle that you wrote off on your taxes. It's a seductive story, but it is an illusion. True wealth is not what you drive, it's what you keep. Choose your deductions wisely. Stop trading your precious liquid cash for rusting metal just to spite the tax man. Build a strategic long-term plan that utilizes retirement accounts to lower your taxes, compound your wealth, and protect your legacy from lawsuits. I want to hear from you. Head down to the comments right now and tell me, are you going to stop chasing the company car deduction this year and look into setting up a solo 401k or a defined benefit pension plan instead? Let me know below. If you found this video valuable and you're committed to protecting your financial legacy, please hit that like button, subscribe to the channel, and ring the bell notification so you never miss our weekly wealth protection blueprints.
Remember, building wealth is hard, but keeping it is harder.
Long-term financial security is a reality only for those who plan, verify, and refuse to let the tax tail wag the dog. Stay prepared, stay protected, and I'll see you in the next video.